Aloha, it's Paul Brewbaker of TZ Economics with part two of a four-part rundown on the post-pandemic Hawaii economy at the time of the 2024 election, just after the election. And again, if you'd like a copy of the slides, feel free to reach out to me, Paul Brewbaker at tzeconomics.com. That's tzeconomics, all one word, .com, and Paul Brubaker with no dots. Part two is going to focus on something at which I'm not an expert, which is labor economics. But because it's been so important in the post-pandemic period and in understanding the way things turned out with inflation and whatnot, it's important for us to think about that in the Hawaii context. And finally, I just want to give a shout out to the Hawaii Economic Association and to CFA Hawaii, who have sponsored some of this work, along with other sponsors who remain unnamed, but you know who you are, and it is much appreciated. Knowledge is cumulative, and these slides do build on work that's been ongoing all year long. As always, any of the views and the content itself is my own and is not the fault of the HEA or CFA Hawaii. But thanks for that help. So let's plunge into the slides here. We're going to talk about the Beveridge curve, inflation, labor markets, and how disinflation was achieved without a recession, without a major disruption to the labor market or an increase in unemployment, as might customarily have been associated with the traditional Phillips curve way of thinking things. And now I am going to pause. Yes, I am recording. So here we go. What the hell is the Beveridge curve? Before we get into that, we got to do some microeconomics here. So think of every local labor market as kind of a regional, regionally imperfectly competitive situation. Imagine the typical national fast food chain, or somebody like Whole Foods with a national presence, but of course local exposures, as operating in these distinct labor markets. Of course, there's no mobility, but in Hawaii, it's not like you can drive to the next county. And a lot of people can't drive across the island because they don't have a car. So there's imperfect competition. There's what's called oligopsonistic or monopsonistic market power on the part of employers. It's not exactly a plantation economy where there's one plantation and everybody works for the same employer. But there's not 30 fast food chains in Kailua. And so in that situation, the firm is going to hire where the marginal revenue product of labor, right? The demand, is it this way for you guys? Anyway, I'm going to do it this way because I'm looking at the same screen as you, where the demand for labor, marginal revenue product of labor, equals the marginal factor cost of labor. Now, if the labor supply curve slope upwards, that means that to get an additional worker, you're going to have to pay a higher average wage. So that equilibrium between marginal factor cost and marginal revenue product of labor determines the employment decision, but the wage that the firm actually pays depends on, or the firms pay, it depends on where the supply of labor is. So you see the black boxes, that's the employment equilibrium. That's actually the employment level on the quantity scale, the horizontal axis, and the wage on the vertical axis. Okay, are you with me? What happened after the pandemic is a lot of people particularly in low wage or low skill occupations said, F this, I'm not going to go back and work for you and face 200 people a day coming into a counter to, order food from me face to face and breathing COVID in my face. And we talked in the last section, we'll come back to this, but in part one, we opened talking about the demographics. The kids weren't born to begin with. So there's labor shortage in the younger age cohorts to begin with. But one of the things the pandemic really did was lead people to reevaluate why they were working at crappy jobs. And so the increased quit elasticity, particularly among young non-college age workers, um, seeking to get compensated if they had to, if you have to be a bartender in a resort hotel and face COVID risk, at least, get paid hazard duty or something, at least hold out. And so that you can see how that increased supply elasticity leads to an equilibrium with a higher wage. Um, and this is from a paper by David Otter and co-authors, and you should check it out because the prediction here helps to explain a variety of novel post-pandemic results from identifying the nature of the imperfectly competitive equilibrium. So things like, you know, half of the wage increase we observe post-pandemic is coming from people changing jobs, right? Rather than wage increases that are associated with the same job. And there's a real reallocation from lower to higher wage employers, not just jobs. So a bunch of patterns that Otter et al. Were trying to explain, and the outcome is remarkable. So nationwide, we saw the real hourly wages of the lowest decile, the 10th percentile of workers, increase post-pandemic, while the our real hourly wages of the highest deciles decreased. What the hell is going on? Right? And we do see some evidence of that in Hawaii, which we'll turn to in just a second. But you have these two weird post-pandemic things happening at opposite ends of the skill and pay spectrum. At the low end, right, the great resignation, as it were, people quitting and quitting jobs and moving to jobs with better attributes and or better pay, who in turn disproportionately moved from lower to higher paying jobs, or moving even to states where the minimum wage was raised from states where minimum wages weren't raised. That was happening at the low end, while at the high end, what was happening is remote work. Working from home allowed high skill, high pay workers to look for a compensation package that had amenities such as remote work or hybrid work, more flexibility for childcare, etc., in exchange for higher wages per se. So you let me work at home and I'll take less of a pay increase. That's actually the way things worked out. And so in another literature, people like Nick Bloom at Stanford and Icicle Sahin from Austin, identified how these patterns. That the quote from Sahin et al. Is that the rapid recovery of the economy on the one hand, com, com, combined with the shift in worker preferences towards working from home and associated amenities as opposed to pay, put downward pressure on the wages of high amenity jobs, while at the same time the Otter effect was happening, Otter, Doob, etc., was happening at the low end. Now, I'll come back to this in a subsequent part. I think it's part 4, but it's important to understand that the impact of working from home, um, uh, just the spatial impact alone, has meant that commercial real estate as well as residential real estate has been affected, and that there's a literature suggesting a large proportion of the increase in home prices that happened post-pandemic is identifiably associated with remote work. But I'll be coming back to that, so I'll just put that out there. Last time, as I mentioned, or in part 1, I mentioned we talked about the fact that the younger age cohorts just absolutely are smaller, and particularly those that are entering the workforce. And by the way, if you look at these are the Hawaii data for males in the age 20 to 29 age group, it seems like there's an extra 20,000 males. Well, that's That's the U.S. military in Hawaii. But generally, the younger cohorts, adjusted for the military, in these, in the teen cohort, in the 20s cohort, are smaller than those in their 30s, 40s, 50s, and even 60s. And right, there are absolutely fewer of them once you adjust for the military. And so that shortage of labor on the supply side, like the absence of replacement, is combining with these demand side effects that were the changes in the elasticity of labor supply, which then, as workers are demanded when there aren't any of them, led to these anomalous outcomes. You'll see on the right side of this slide uh, the dependency data, but it's important to note that a century ago there were 30 working age persons in Hawaii for each person 65 and older, and today there are 2.5. So 30 persons for each 30 working age persons for each so-called retired person. 50 years ago it was 10. Today it's 2 or 3. In the 2030s it'll be 2, only one of whom is a college graduate, if you want to think about where the skill sets are. So very different challenges in terms of productive capacity than we had a century ago in Hawaii. So this, as I alluded to this a second ago in the Otter paper, this unexpected, so-called unexpected compression in post-pandemic real wages occurs at the low end of the wage spectrum. Those wages rose faster than real wages of higher skill, higher paid workers whose whose compensation actually went down because they were getting compensated in other ways. And among the outcomes was that the wage inequality that occurred between the 1980s and the 20 teens, 40 years, we had, you know, a dramatic post-war diminution of wage inequality in America, and then a widening over the 40 years from about 1980 to 2020. Uh, 1/3 of that has reversed out in just the few years after the pandemic. So this is a really dramatic shift. Just to try to see some of that, it's it's harder to see in the Hawaii data. We don't have, the longitudinal data that can be pulled together nationwide. But here's a couple examples. Look at real average hourly earnings in leisure and hospitality industries, so the heavy blue line, as opposed to real average hourly earnings in professional and business services in Hawaii, right? The dashed line. Now the immediate, in the late 20 teens, they're sort of meandering around. This is indexed to the end of 2019. So real average hourly earnings between professional and business services workers on one hand and leisure and hospitality workers on the other, they're sort of moving around, basically ending up in 2019, or in the neighborhood of where they were a year or two earlier. Then comes the pandemic, and the professional business services workers can all work at home, and the leisure and hospitality workers can't work at all because there's no tourists for 6 months. And so there's a big split in their real wages, real earnings, I should say. So that includes, benefits. And then what happens as there's the inflation surge of 2021 carves away at real earnings. But then as soon as this recovery occurs, leisure and hospitality wages move up very quickly. And notwithstanding the Maui wildfires a year ago, largely kept up and arguably had a better run if you look from the bottom to the top over the last few years. So which one is this? This is hourly earnings, and this is, I'm not even sure what this is. Why is this different? Quarterly index, seasonally adjusted. Oh, one scale, and oh, these are the actual constant dollar estimates. Okay, so $25, $30 an hour. So you kind of get the picture. Another data source we can look at for Hawaii, these are average annual pay statistics. Obviously, you don't have 2024 yet, it's not over yet. But here again, if you benchmark to 2019, line everything up, start at 2019, and you can see how prior to 2019, wages of arts, entertainment, and recreation workers, that's the thin blue line, we're probably increasing the fastest. That's kind of interesting. But I want to highlight food services workers, which is the dashed line with the yellow dots. Highlight food services workers, and again compare to professional, and in this case, professional scientific and technical services workers, the heavy navy blue line, to make this point that pre-pandemic, food services and drinking places workers were rising faster than real average annual pay of professional scientific and technical services. Then were depressed by the recession, by the COVID recession, and then came back even stronger to end up moving even more as of last year than real wages of professional scientific and technical services workers, many of whom were able to continue working remotely during the COVID recession. So that's another bit of evidence, and uh, what are we looking at here? I can't remember what I did with these slides. Um, so let's try to figure it out. So this is average annual pay, and these are total annual wages. I'm not sure what the difference is. But again, a really strong recovery on the food services side relative to um, earnings in accommodation, arts, entertainment, and recreation. What is the difference between those two? I don't know. You look at it carefully and you figure out, right? These are indexed to 2019. So are these. Huh. Anyway, okay. Well, that's why I'm not a labor economist. So what is the deal with tight labor markets? Here's an interesting way of looking at it from the standpoint of Google Trends. I don't know if you've done this before, but you can go search Google Trends on search phrases, in this case, tight labor market. And you can see that prior to a decade ago, nobody ever looked up these data. Remember the jobless recovery of the early 20 teens? So what do you mean tight labor market? There is none. But in the late 20 teens, you see this. And then especially post-pandemic, you see a surge in searches on the phrase tight labor market having to do with the way labor market conditions change. So one of the interesting papers that came out of the annual Jackson Hole meeting was a paper revisiting what's called the Beveridge Curve, which is something we don't even teach undergraduates sometimes, um, which is the relationship between um, the unemployment rate and the vacancy rate or the job opening rate. How many jobs are open, uh, seeking to be filled, as a percentage of the sum of the jobs filled and unfilled. So if you look at job openings in Hawaii, as well as nationwide, there have been a gradual drift upward. That's that tight labor market condition, a gradual drift upward from 3 to maybe 4.5% of all occupied and vacant jobs combined, with the quit rate rising from 1.5 to maybe 2.5% prior to the pandemic. Then comes COVID-19. That's the vertical line. I forgot to label it. And post-COVID, you see this huge surge, and take this job and shove it. Uh, um, Job openings, quits surge, but job openings surge even more. The employers found it extremely difficult to fill vacancies, and basically we got to a point where there were 2 job openings for every person unemployed in Hawaii. If you divide the vacancy rate or job openings rate, if you divide the vacancy rate by the unemployment rate, you get this convenient measure of labor market tightness. This measure theta, okay, which is V over U, the vacancy rate divided by the unemployment rate. And when the Beveridge ratio, when theta is greater than 1, it signals the tight labor market. We had a tight labor market at the end of the subprime bubble in the early 2000s, and then we went to jobless recovery in the Great Recession and early 20 teens. And then prior to the pandemic, Hawaii faced a very tight labor market. Now, part of the reason is something we looked at in part 1 of this series. people were leaving Hawaii in 2017, 2018, 2019. So part of the tight labor market, the part that's unique to Hawaii, is that Oahu, in particular, lost population in large numbers. And we also noted in the data that, there are 30,000 fewer persons employed or fewer jobs in Hawaii today than there were in the 2 or 3 years prior to the pandemic. So it's not the pandemic. This was happening before the pandemic. And then, of course, after the pandemic, the Beveridge ratio again shot up as that job opening rate surged with the great resignation. Now, notice that this is a similar but much more distinctive pattern than the one nationwide. Nationwide, the Beveridge ratio post-pandemic, was a big difference from what had existed before. In Hawaii, we had already been dealing with this a little bit. So that's kind of distinctly Hawaii. And again, this is that period in the pre-pandemic, late 20 teens, when people began leaving Hawaii on net in numbers larger than all other sources of population growth combined. Now let's look at V and U in a two-dimensional space. So we've got unemployment rate on the horizontal axis, the job opening rate, V on the vertical axis, U on the horizontal axis. And you can see the pattern pre-pandemic of an inverse relationship, right? When there's a lower unemployment rate, there tends to be a higher vacancy rate, right? The labor market's tighter, more vacancies. And then when there's a lot of unemployment, as there would have been, say, in 2010, in Hawaii, a 6 or 7% unemployment rate, the vacancy rate is relatively low. It's easy to find workers because there's so many unemployed workers. There's just a job mismatch or skills mismatch problem that you have to overcome in many cases. But if you look carefully, and then this ratio, Beveridge ratio of 1, would be the 45-degree line. Okay, are you with me? So theta equals 1 is sort of this crossover point to the left of the 45-degree line. The labor market's tight. Theta is greater than 1, and below, labor market's loose. And it turns out 1 is not quite the threshold. It's the true threshold was a little bit more than 1, maybe 1.1, maybe 1.1, but 1.2. But what happens at that point, if you look carefully, is that this nice, smooth inverse relationship I estimated here, it's not actually accurate. It's a little bit more L-shaped. So let's run those regressions. And what you see for the whole sample of about 20, 23 years of data, quarterly data, while it looks like there's a positive slope on the left side here, and I've adjusted for the increased dispersion, heteroscedasticity, when you just look at the last decade, that kink really comes into focus. And here I just hand drawn in the kink with the original regression superimposed. Gowdy Eckerson presents this paper co-authored with Benigno about why this is different. And what it has to do in this post-pandemic soft landing disinflation a moment of history. And the key here is to think of the kink in the Beveridge curve as showing up as a kink in the aggregate supply curve. So now let's look at the left side page and walk through those economics. And we're doing a lot of micro here today. So the original equilibrium, right, aggregate supply, aggregate demand meet up at Y0, which is less than full employment, Y star. So there we are in the pandemic. We're at less than full employment. We've got an inflation rate of Y0. So that's the starting point. And then there's a fiscal stimulus. And then there's a monetary stimulus. There's simultaneously a fiscal and monetary stimuli, a demand shock. Now, if you believe that the aggregate supply curve is smooth, then inflation would have gone up to pi 1. But because of this Beveridge kink, because of this anomaly in the labor market, the kinkiness in that essentially in the labor supply, where you kind of hit the wall, the aggregate supply curve has this upper kink. So the same demand shock, which would have otherwise raised inflation to pi 1 had it not been kinked, actually turbo supercharges the inflation to pi 2. But you have to remember what's happening after the pandemic is people are bailing from the labor market. They're like, hell no, I'm not going to work. I'm not going to work now during pandemic, and you know what? I'm not going to come back until I can get the right job this time. What was I doing in that stupid job before? So the aggregate supply curve with the kink is actually shifting to the left as aggregate demand is moving out. And there you have that surge in inflation in 2021, peaking in early 2022, that leads the Fed to intervene with tightening of monetary policy, very aggressive tightening, following its very accommodative easing in the immediate post-pandemic onset. Now, ordinarily, you'd expect a dramatic monetary policy tightening to be associated with a recession. And for years, people were predicting, oh, there's going to be, if you go look at the media will tell you that all the economists were saying there's going to be a recession. Not all. Yeah, you can go watch my videos. I didn't think there was going to be a recession. Why? Well, I didn't know this is why. It just didn't feel. I mean, I had faith that a soft landing was feasible because I lived one in the 1990s, and it seemed to me that the conditions, which weren't exactly the same, nonetheless were made it possible for the Fed to achieve it. Now we know from the Eggerson paper, Menino and Eggerson paper, that what happened on the right side of the page is of the screen during the monetary tightening interval from early 2022 through mid 2024, middle of this year, the vacancy rate in Hawaii went down without the unemployment rate going up at all. No recession. The unemployment rate did not change, but that vacancy rate, the job openings rate, came down dramatically, vertically, from 7% to 4%. And so you have to imagine the aggregate demand shock dissipating, the initial shift to the right, and the aggregate supply shock, the initial kinky shift to the left, dissipating as well. And as they both go back to, say, Y star, you have that vertical diminution of the vacancy rate on the right-hand side of the screen with the squiggly orange arrow, dashed arrow, accompanied by the straight dashed arrow from pi prime back to pi zero, or not, something a little higher than pi zero at Y star at full employment. And that's what you saw. These are the Hawaii data. Again, I filled in all the data this time, including the post-pandemic period. So the Beveridge curve took a wild jump in 2020 out to 23% unemployment, and then took a long, climb up into these high, not just high HI Hawaii, but high HIGH job opening or vacancy rates. But then in the course of the 2.5 years from the beginning of 2022 through 2024, came down vertically. Now it raised the question of where are we going? I don't know. Hawaii faces a really complication with people leaving, and I'm thinking they're starting to leave the neighbor islands. We know they're leaving Maui, and they were leaving Oahu, and they're still leaving. So we'll just have to see. Maybe the labor supply shrinks enough over time because people are bailing out because it sucks to live in Hawaii for some reason. For them, it does. That's why they're leaving. That the labor market stays tight, and we just go into the steady state in a shrinking economy. Welcome to Detroit in the 1970s. Now, a couple side notes. Unit labor costs did go up dramatically. These are nominal measures in Hawaii. Productivity did not. Output per worker, productivity, non-farm labor productivity measured by the BLS, not looking too good for Hawaii, whereas on the mainland, productivity most recently has been on the upswing. It surged initially, and that's kind of a head fake because of remote work. So for the people that were working, right, it's a composition effect. The pandemic disproportionately affected lower productivity workers, so it made the average go up. But subsequently, productivity has been rising, even though unit labor costs did rise nationwide in compensation, in large part for the inflation event. And by the way, wages did rise to compensate for the inflation event. So Don't listen to what other people tell you about this. Okay, see it. That's the end of part two. And stay tuned for part three. At least that one was shorter. Aloha.